Good morning, everyone, and thank you for joining us today at this webinar on how to grow your business through acquisition. I'm delighted to be joined by Andy Bissett, who's a commercial finance specialist, and Nathan Winch, who's a private equity investor. And we're going to be taking you through today for the next sort of 50 minutes or so through some of the deals that we've worked on, and we've worked collectively now on quite a few deals. And talk you through opportunities of how you can potentially grow your business through acquisition as a model. There is a question and answer function at the bottom of the screen, so if you have any questions at any point during the course of the webinar, please feel free to type them in and we'll come to them at the end of the session. In terms of the format for today, we'll each individually be speaking for around about 8 to 10 minutes or so on a particular topic to do with growing your business through acquisition. And then we're going to have an open discussion around some of the more practical issues I think that we've seen when dealing with mergers and acquisitions work, and obviously answer any questions that you may have at that time. So a bit about us at Ison Harrison Solicitors. So we've got 16 offices around Yorkshire. I'm one of the directors of the firm. We're a reasonably large firm, top 20 in Yorkshire, top 200 nationally. We describe ourselves as the most accredited law firm in England and Wales. Law firms can apply for various independent accreditations, and we've got more than anyone. We're a full service law firm, and we're 100% owned by our employees. So we deal with everything from private client work right through to the full range of corporate and commercial services, and I head up the corporate and commercial services at the firm. So a bit about the webinar overview. So I'll kick us off talking a little bit more about legal process around a merger and acquisition. Then Andy's going to be talking to us more about funding options. Nathan's going to be speaking about identifying possible opportunities. And then, as mentioned, we'll have a more open discussion about some of the deals that we've been involved in, some of the scenarios that we've come up with, and answer any questions that you may have at that time. I want to start off by talking a little bit about the market as it stands at the moment. What I would say is over the last 18 months, 2 years, the M&A market has been hugely active, both regionally and internationally as well. And I've included a quote there from someone at PwC, who is their international head of mergers and acquisitions, which anticipates another very strong year this year for mergers and acquisitions, and certainly in the first quarter of this year we've probably done more transactions than at any other point previously, which shows how buoyant the sector is. In particular, we're seeing a lot of activity in the sort of tech, hospitality, leisure, education and transport sector. But why? It's kind of a perfect storm, really. You've got sellers who want to get out. COVID was perhaps the final straw. Money's cheap, market uncertainty, and actually, some certain businesses might have struggled over the last year or two, which obviously will have brought down their EBITDA, and means that there actually potentially have some quite good deals out there if you find the right opportunities. So that perfect storm of is given rise to an awful lot of activity in the sector. Why look at an acquisition rather than maybe organic growth? Well, there's certain advantages potentially to acquiring other businesses, in that obviously it's got an existing client base, existing brand reputation, it has an existing market share, and Andy will come on to a little bit later about some funding options that potentially you can leverage some of the assets currently within the business, within a target business. So actually the money down into such deals doesn't necessarily have to be significant. Potential negatives, and something that we need to watch out for, and something that I'll talk a little bit more about, is understanding what it is that you're acquiring, and what the risks and liabilities are associated with that business. So a little bit about the structure and process. So you start off obviously identifying an opportunity and engaging in discussions with them. There's a few underlying points that you need to understand apart from the headline price, which is actually, is there going to be any what we call deferred payments? Is there going to be payments over a period of time? How are you structuring the deal? Are you buying specific assets out of a business or a particular team, for example, or the goodwill? Are you going to buy the entire business or share purchase? And understanding that at an early stage is quite important. You then move on to heads of terms. So we look at that's an overview of the actual deal itself. They're not legally binding, but it's the understanding of the parties at the outset as to what the deal structure is going to look at. One of the important points which often gets overlooked at that point is understanding what the target net asset position is of a business. Obviously, business finance changes on a daily basis. They could be having increasing debtors, so people that owe them money, their cash position may change, and actually setting out what's the party's understanding about what the financial position is going to be in a business at the point of acquisition is quite important. And I'll come on to actually this is potentially a way of stealthily reducing a purchase price, but I'll come back to that a little bit shortly. You then conduct a much more detailed due diligence process. You'll look at things like the accounts, employees, contracts, what have you. Negotiate the sales contract. Share purchase agreement could be 60, 70 pages plus, and largely because you're going to want the seller to give you plenty of warranties, which protects your position, so that you know what it is that you're buying, and so that there's potential recourse against the seller in the event that there's inaccuracies in the information provided. So in terms of the due diligence, some of the key points to be looking at, you need to understand what the liabilities and the financial position is of the business. Have they got outstanding indebtedness, for instance, a CBILS loan? Vehicle finance is a common one that we just need to be clear about what the position is on that. Employees, has there been furlough? Are there potential issues around that? What's the position regarding redundancies and employment-related liabilities? Property, is the freehold property? Do you need to get a survey around that? Do you need to understand whether there's any possible issues around the freehold property, much as if you're buying a residential or commercial unit? Long leases and understanding the opportunities around renewal of a lease. Are you potentially going to have to move premises? And crucially, probably the client base. Has market conditions affected that client base? Are they on long-term contracts? Is there anything that you need to be aware of around that? So some of the documents that we'd request for you when undergoing an acquisition: leases and commercial property inquiry forms, lists of assets, contracts for the suppliers and customers, a whole host of information about employees. Ordinarily, you want to see at least 3 years accounts and bank statements for probably 12 to 18 months, so you can check that the outgoings and ingoings are as per reported. And then obviously certain sectors are subject to certain regulatory requirements. That can be really important to understand. Some of the problems: disorganized and uncooperative sellers, that's a big one, and they can tell you a lot about the business, and actually you're requesting information and that is not forthcoming. And actually you need to understand what it is that you're getting involved in. One of the questions often is if payments are being made over time, and a lot of deals now, the majority I would say, do have deferred payments. What sort of security is a seller going to ask for around that? Are you going to be having to think about things like personal guarantees or debentures of the company? And there's a host of opportunities around there that you just need to be discussed. And as I said, certain businesses are subject to quite strict regulatory requirements. So for instance, if it's a healthcare business, you're going to have CQC. Law firms have the SRA. There's a whole host of other matters, potentially licensing issues, that you just need to be aware of. Buyer versus seller issues. So there's a bit of a conflict here. Obviously, buyers want to get the best deal possible. They want to pay as little as possible. Sellers obviously want the most amount of money ultimately. And it's trying to get a meeting of minds as to what the expectations of the parties are. So understanding your EBITDA, understanding your finances. Was there any exceptional revenue? What's the directors taking out personally out of the business? What's the cash and bank position? That's important. And I mentioned earlier, one of the important points on an acquisition is to try and agree early what's the expectation of the financial position at completion of a business. Is it what we call a cash-free, debt-free transaction? So you're essentially expecting nothing to be left. There's no liabilities, and the cash in the business is essentially sufficient to cover those liabilities. Or was the offer made on the assumption that there was going to be a certain amount of available cash or available assets in the business. Now, I have to say that a lot of sellers, and indeed to a certain extent a number of lawyers, don't necessarily understand this properly, and so it is a way sometimes of indirectly getting a price reduction. Let's say that you've agreed a headline figure of 500,000 for a business. There would then be an adjustment process after completion called completion accounts, which will then marry up the actual financial position on completion. Now, if the assumption was that there's going to be a cash-free, debt-free, then that adjustment will be nil. There'll be no excess cash in the business. But actually, if you can set a target net asset figure, target working capital figure of 30,000, 50,000, 100,000, whatever that's going to be, indirectly that will reduce the price. So it's something that needs to be looked at on a case-by-case basis, but there are some opportunities around that. Freehold property, this can be held outside of a limited company by an owner individually, or potentially in a pension scheme, and what's the arrangements around that. And then leverage buyouts, which I think Andy's going to talk a little bit more about shortly. So that's really sort of an overview of the process. It's obviously a lot more involved than that, but it kind of gives you a timeline of events such as to what you need to be looking out for. And we'll come on to a little bit more later in terms of the discussion as to, in practice, how that works and how the different parts around raising finance and legal process can interact. But I'm going to pass over to Andy now, who's going to talk to you a little bit more about funding opportunities around that. So over to you, Andy.
Thanks, Richard. So in terms of the funding options, I'll get to that in a second. I just thought I'd do a bit of advertising about myself, because not a lot of people know that I am a commercial finance broker. I actually started the brokerage in 2020. Our team have got over 40 years experience within commercial finance industry, and that's working directly with and for lenders and private lenders as well. We are directly authorised by the FCA, and we're a member of the National Association of Commercial Finance Brokers, which I'm very proud of. And you might think 8 leverage transactions supported in 2021 is not very much, but actually most of those happened towards the end of the year. If you remember 2021, we were all still, and to some extent are, living under COVID, and at the start of 2021, everybody was locked down. So the vast majority of those were actually conducted towards the end of the year. What I'm going to talk about today is, once you've identified the target business, you've obviously got a target amount of money that you want to try to get to, and it's how do you get to that. In terms of the process from a funding point of view, everything that Richard said is absolutely valid, but alongside that, having a look at the accounts, bank statements, and actually having a look at the affordability, both from the perspective of the business that you're looking to acquire, as well as the business that you've already got, makes a massive difference in terms of actually what debt can you afford. In terms of the assets, again, it's looking at both sides of the coin. It's looking at your assets, looking at the target business's assets. And I'll come on to those in a minute. Richard's already touched on this, but in terms of liabilities, how geared is your business? Do you have lots of debt outstanding? And does the business that you're actually looking to acquire have got lots of outstanding debt? Quite often, if a business is looking to sell, they actually quite often pay that debt down. So it makes it more attractive for you to purchase. In terms of types of asset, I get asked this quite a lot. The main ones, and this isn't an exhaustive list, but the main ones are any property within the business, any debtors, plant and machinery, or cash. The other thing that I could stick on there is stock, but that would be depending on what type of stock it is and how valuable that is to a funder. In terms of types of finance, you might think this is absolutely obvious, but it absolutely isn't. Invoice finance, asset finance. So invoice finance and asset finance are a mechanism of being able to increase the amount of cash in your business. Asset finance obviously uses plant and machinery, any vehicles that you've got. Invoice finance is mainly around the debtors, that an outstanding debt that is owed to the business. Commercial loans, again, it can be more complicated because there's certain schemes that have been around, such as the enterprise finance guarantee scheme in the past. Then it turned into the CBIL scheme, and at the moment the RLS scheme is in effect, which means that up until £250,000 worth of debt, the company doesn't actually have to put a personal guarantee, so they do need to put a personal guarantee. They don't need tangible security for that. So that's very useful to use if you can. Asset-based lending, this is different to asset finance. It's a common misconception. Asset-based finance is a combination of invoice finance plus either asset finance, property finance, stock finance. And that's just wrapped in one facility. Some people call that a revolving credit facility. And the other type of finance is obviously cash flow lending. So what amount of cash does your business generate, and can you predict that going forward? We usually work in multiples of EBITDA to be able to work out what cash flow lending the business can afford. In terms of due diligence, I put due diligence and legals on there because actually it does go hand in hand. The first point is a sense check. Does it make sense that this business that you're looking to acquire fits within your business? Is it absolutely right that you do that, or is it a completely different business to you? Like, have you got experience in that business? Quite often there's a valuation, so if there's a property involved, or if there's lots of plant and machinery, there will be various valuations that take place. If there's an invoice finance facility in place or an asset-based lend, there'll be an audit and survey, which is the lender going out and looking at the business that you're looking to acquire and reporting back in terms of are they comfortable that the right process and procedures are in place. They'll also let you know around things that you might not quite understand in terms of are there a high level of dilutions with the debt, which means that does the business issue credit notes? So in other words, if you've got £1,000 worth of invoices owed to you, how much of that is actually true proper debt that will get paid? And once we've got all that, then we go to the credit underwriting stage, which is the lender then formally looking at the business that you're looking at acquiring, looking at your business and deciding whether they are comfortable lending that money to you. That's me, thank you.
Just to follow on from that, just to explain the mechanism for a leverage buyout and how you can actually use the assets within your target business. So obviously Andy's talked about things like asset finance, invoice financing, things like that. And what you can do as a mechanism potentially is the target business is the one that takes out that money, takes out that finance. And then there is a loan between the target company and the company acquiring that business. And then the business that's making the acquisition is then pays that money over to the seller directly as an individual. So you have this kind of triangle, and you end up in a situation whereby there's an intercompany loan between the target business who's taking out the finance and what will end up being the holding company, which is then paid down over a period of time in the years after an acquisition by way of dividends and money being moved between the two companies once that group structure is put in place. So there is a mechanism there, is what I'm saying, whereby you can actually use the business assets of the target that you're acquiring to actually fund the deal or fund part of the deal. I can see we've got a few questions come through. I'm going to come back to them at the end, so thanks for those. But now I'm going to pass over to Nathan, who is a private equity investor and has really built a business on acquisition, haven't you, Nathan? So over to Nathan now.
Thank you very much.
Right clicker, right, there we go.
Hi everyone, my name's Nathan. I run a company called Winch & Co. We're basically a small investment company based here in Leeds, and we sort of do this as a main function day in, day out. So Richard's kindly invited me along to talk about how we identify opportunities, what we do with those opportunities, and how we work with guys like Andy and Richard to then kind of piece that together with the rest of the deal team and make it work. So One of the things that we look for when we're trying to identify businesses to buy is we'll have a mandate, and this is how we'll differ from perhaps some of the people on this webinar, is that if you're looking to grow your business, then we'll do the same sort of stuff, but what we have to do initially is we pick an industry that we like, that we either have experience in or we can buy experience in for, and essentially then put together a mandate of what we want to do. It's an investment mandate basically, to say this is what we want to buy, this is how we're going to buy it, these are the people that are going to be involved with helping us, facilitate those deals, and this is going to be our exit strategy of what we want to do. So that's just that particular to what we do, but how these things are executed will be the same for everybody doing it. So one of the industries that we've identified at the moment that we're in is haulage and transport and logistics. So any business really that's in that sector. And how we kind of go about that is we have an in-house team and an outsourced team of researchers. So we'll give them criteria of what we look for. That criteria is built into some of the products that Andy talks about in terms of commercial finance. So we're from the outset trying to kind of build that mandate around how those products work, how they're funded, what we have to do, and then kind of piece it all together really. So we'll go out there, we'll have lots of different communications to find our leads, lead generation, proprietary deep networks from contacts, things like this, referrals, and things like that, even as basic as sending letters to businesses that we identify. So we'll produce a list, we'll take that list and we'll break it down. We'll look at hundreds of, even thousands of balance sheets actually to see what works, what doesn't, that matches in with the industry that we've chosen. And then basically say, can we afford to buy this business through both either using our own funds or leveraging the assets in that business. So we've got to kind of take a bit of a punt, because obviously Companies House only shows so much of the picture, and then we'll then contact those businesses and say, look, do you want to sell? So relating to people on the webinar that perhaps once they grow their business, you're already in a sector, so you already know what you want, and it's a case of looking for people that want to retire, looking for people that are looking to exit their business for whatever reason, they have other interests, they've built up enough cash that basically they want to just enjoy their life, buy loads of property, get out of the trading game, that sort of thing. And that's one of the key points that I'll identify is probably 95% of what we've bought has been business owners looking to retire. So this will apply to your competitors. If you've got competitors in your industry that maybe even if they're bigger than you actually, taking all those competitors through a leverage buyout like my colleagues are talking about today. So the next step for us is to then look at these businesses, we'll contact them, they'll reply, the ones that are interested will reply, and then we'll basically do an information gathering exercise to see, right, on paper we know we can do this deal, now we need to learn about the owners, what their motivations are, what the business looks like, what the challenges are, and all the rest of it that Richard spoke about at the start of the webinar. So things that we look for, me and my team we all have our different specialisms. We look at the debt in the business already. So lots of businesses around the COVID time, they'll have the civils and bibbles and whatever else you want to call it, the government funded aid. So there's lots of unsecured debt in a lot of these businesses, and sometimes that's the reason why these guys want to exit. You know, they've loaded themselves up with debt. They're looking to retire anyway, or whatever the reason is. So we'll look at that business, we'll look at the financial obligations that it has. We do like regulated businesses, that's just a preference of ours, because it's higher barrier to entry. And then we'll kind of work with that business owner, speak to them, have meetings, look, do you want to sell, try and agree a price, and then see how we work towards that price essentially. So one of the things Richard pointed out there just before is how a leverage buyout works. So one of the ways to think about it, because I know that a lot of business owners are thinking about risk, and there's a lot of debt involved with leverage buyouts. So one of the ways to look at it is if let's say you want to buy a house and you haven't got the cash to buy that house. So typical residential house purchase. So you go and get a mortgage, but in a leveraged buyout, you've got to imagine that actually the house will owe that money and not you, depending on how you set up the structure. So typically what we'll do is we'll have an intermediary holding company which will execute the transaction. That will have the deferred consideration. So if we decide to defer consideration, part of the purchase price we always defer. So we say to the owner, you need to give us warranties on the accuracy of the information that you've given. That could be debtors, creditors, length, sort of commercial contracts, stat employment contracts, tribunals, or any other staff looking to sue for whatever reason. So we get warranties across the various different areas of business, and the way that we enforce those warranties is to have an element of deferred consideration, so deferred payment. Typically for us, that's 25 to 30%. I've seen it as high as 50%, even more in some cases, and that's how we can then claw back money if, as Richard said, there are inaccuracies in the information that's provided. We've had to do that on one particular deal that we've done, so that's the reason for deferred consideration. So we'll then come to heads of terms, where basically we'll outline what collectively we've agreed to pay for the business, how long, the agreed indebtedness, and as part of our heads of terms, we'll get a unilateral purchase option agreement signed as well, so that these guys can't go off and sell the business, and we've wasted all the time and money that we've spent on due diligence. And then we'll go and inspect the business, we'll go and see the business, we'll go in and meet the guys, the owners. Typically, you know, these owners are quite protective over the staff, so they don't want the staff to know that they're selling before they've sold. So we might go in and you know, they tell us that we're funding insurance or whatever, just to you know, keep that, so we can do our due diligence without kind of frightening anybody, because you know, private equity takeovers, it's got a bad rep at the minute. So we'll go in, we'll do that, we'll say yes, this is the business we want to buy, and that's when, alongside that, we'll have been looking at the funding options. How are we going to fund this business? Do we need to put any equity into the deal or not? And pre-agreed that, so that all the different parties involved, us the buyers, our solicitors, Ison Harrison, and our commercial finance brokers at Shadowfax, we're all then ready to go to execute this deal on a target date, provided all the net assets, the target cash in the business for working capital are all met, or there or thereabouts, and then we execute the deal. So that the finance is taken out in the target company. As Richard says, it's then moved around via loan or dividend to whatever your acquiring vehicle is, SPV, and then it's paid to the seller through escrow and the solicitors. And I say it's as simple as that. It's not simple, but there's always hiccups along the way. But that's in a nutshell. That's the process. So we're trying to target businesses where we want to keep the amount of money we're investing as low as possible, so that our return on investment is as high as possible. So the way to do that is we want to look at businesses that have a big asset base, that have property, that have unencumbered assets, such as vehicles and transport businesses, that we can then leverage to help contribute towards that purchase price. And we have this obviously worked into the deal beforehand, and then we have to do things like valuation. That's part of due diligence. And the beauty of the leverage buyout is that the lenders that you're working with are going to do a lot of due diligence themselves, because they want to know what they're lending against, they want to know what the collateral is. So we get help we obviously have a team that do due diligence, our solicitors will do due diligence, our lenders will do due diligence. So if there's anything that's going to crop up, one of us is going to find it. So that's a beneficial help of having a lender as well. Finance then taken out, the deal's done, all kind of works simultaneously, whether that's mortgages, asset-based lending, invoice finance. We typically have one or two products that we use to get the deal over the line, and we like to give ourselves some headroom. We don't want to leverage to 100% of the entire business, because then we're basically loading this perfectly good business up with lots of debt, and you know, this business has got staff, employees, other people that rely on it. So we try and have some headroom for when mistakes go wrong, and mistakes do happen. You know, we do tend to have to stump up some money afterwards to make things happen, or cash flow issues, or even where we make a mistake over cash flow and, you know, the business might be seasonal. That's another thing to look at. So do you have cash available for debt financing throughout the year? Because, you know, a lender has to be paid every month on the dot, you know, but can your business afford that? So lots of considerations, lots of stuff I'd like to go into, but I know time's limited and people want to ask questions. So, I mean, in a nutshell, that's what we do. We all work together to make that happen.
Well, thanks for that, Nathan. So just I suppose moving on, we've got a couple of questions through, which is great. Nathan, so I just wanted to touch on. I think you dealt with this to an extent. How important is it, in your view, to develop a personal relationship with the seller? Because obviously the lawyers get involved, and we have to protect our relevant clients' interests, and you know, but ultimately the parties want to get the deal done. In your experience, you know, how important is developing that relationship?
I think it's incredibly important. In fact, a good example, I can't name the names because we're obviously under confidentiality, but we had a particular deal where we built a very strong relationship with the seller, and you know, we like to think of ourselves as comfortably professional. So we're not too professional, which can sometimes put sellers off, particularly in the industries that we target, because these are hard-working grafters, workers. You know, they're afraid of suits and things. So we go in and we build that relationship. And a good example with this particular business that we've agreed is going to enter terms is actually there was another buyer involved that had offered more money, and the reason they went with us is because they said they could get along with us, they could see themselves selling that business to us. We talked to them about continuity, because a lot of these business owners, whilst they want to retire, they don't want the business to end, so they want to see succession planning, continuity, and we give them that, because we're not coming in and asset stripping and doing whatever. So relationships absolutely important. Yeah.
Who is running this business? So whether it's going to be you or it's going to be existing management team, quite often when somebody's looking to sell, they've built up a little bit of a management team, but have they got the management team that will actually want to take on the business? And that, you know, there becomes a tipping point where you've either got that and you've built that up yourself and you know where your exit's going to be, or you don't.
Mm.
And if you don't, then you know, somebody like Nathan coming along saying, "I'll buy your business," is very, very attractive. The lender will always want to know, well, is Nathan going to run the business?
Mm.
If so, has he got experience? So, you know, if Nathan's got a haulage business and it's a very successful haulage business, and he's looking to take over another haulage business, then it kind of ticks the box. The questions then would be around, well, how is he going to run two businesses, and how are we going to get efficiency of scale and all that kind of thing? If Nathan says, well, I've got a haulage business over here, and I want to run a care home or something like that, then clearly there's going to be far more questions around actually, well, what experience have you got in that? And you might have a really good management team in place that could run the care home, but actually, are they experienced enough to know that something's going to go wrong, and therefore is coming back to Nathan, I'm sorry, I'm using you as an example, but have you got the experience to then know that actually something in this business is going wrong, and you can spot it, and you can spot it early? Because any sort of early warning signs usually come from the management team, because they're the boots on the ground. They can see what's happening with the business. They've got the experience, and hopefully you've got experience in running that as well. There are times when people do buy businesses that they haven't got experience in, and they are very reliant on the management team that is already there. And actually, again, depending on that experience of the management team, there'll be due diligence around that as well.
Yeah, I think from my perspective, one of the things that we see on acquisitions is in a lot of businesses, there can be quite often a key individual or series of key individuals who might not be a seller, but it might be a sales director or something like that. And one of the things to look at potentially post-acquisition is what incentives, if any, do you need to put in place to retain that person? Do you look at some sort of profit share, bonus, some sort of growth shares? It's not necessarily the focus today, because there's not a lot of options to go through there, but if you do identify a key person, then they are business critical to make sure that they stay in place. So that's something that we can certainly discuss. So just looking at some of the questions that have come in. We've had one about how you go about identifying opportunities, Nathan. I think you've obviously covered that off. Obviously, there's a lot of central sites, a bit like Rightmove, Dalton's Business, RightBiz, things like that, where you can go and actually look at businesses that are already for sale. Potentially talking to accountants or corporate finance companies. They may know of people who are interested in sales. So there's lots of areas, as well as some direct marketing as well.
There's a key point there as well, is particularly if you've never done an acquisition before, is to just be wary of the different options. So
yeah,
I know that business transfer agents or the likes, there are lots of good ones, but typically you want to look for how to value that business, because some agents can be guilty of overvaluing a business and to get it listed and all the rest of it, and they make their money on listing and things like that. So I think just to make people aware that it's not all cut and dry. There's lots of different things to consider.
Yeah, I think ultimately for a buyer, it's about deciding what you are willing to pay for that business. And we've got a couple of questions which follow a very similar theme, which is there a standard multiplier of EBITDA that gets applied when applying a valuation? The short answer, in my experience, is no, because it depends on the sector. Certain sectors, accountancy, for instance, and financial advisors, where they have a high degree of recurring income, have a relatively standard multiplier that gets applied, but it's very different. For instance, in a high growth area, like maybe tech or some sort of app or something like that that's being developed, it's got a lot of growth potential, you might get a higher multiple of that. But certainly in my experience, that there's not a standard, right? It's not 3 times your EBITDA across the board. It might be in certain sectors. Nathan, Andy, I don't know whether you want to add in anything on that.
It's a very good point. There isn't a standard multiple of EBITDA. It has to make sense. It comes back to that sense check. Does it make sense that you pay, if you're willing to pay £10 million for a tech business, does it make sense? And what checks and balances have you got, and what proof have you got that actually it's worth that sort of money? It's a little bit like, again, going back to your example with the mortgage. You want to buy a 4-bedroomed house on the outskirts of Leeds. It's going to be more expensive than in a different part of the country, but you might really want it, so it might make sense to you because you might have other aspirations, because that tech business might complement your business absolutely perfectly and make your business fly. So it will have implications in terms of the funding, because obviously it has to be affordable. But if you're putting lots of money in yourself, you can pay what you want for it at the end of the day.
Yeah, I agree. And I think what we found with sellers is they don't actually care what the value of the business is. They have a figure they want for other reasons, whether that's, they want to retire, move to Spain, which is one of the ones that we had, and they just have a figure they want and need. Sometimes it's more than the business is worth, and sometimes it's actually less than the business is worth. But it's like Andy said, it's a sense check. It's what we're prepared to pay and what they're prepared to be paid, isn't it, really? I
think going back, just fundamentally, when we're talking about a multiple of an EBITDA from a buyer, in theory, what you're saying is, how many years do I have to own this business before I actually see some profit out of it? So if you're saying it's a 3 times multiple of EBITDA, on paper at least, you're saying, I need to own that business for 3 years to pay off what I bought for it. Now, obviously, that's an overly simplistic analogy, but because obviously you've got growth factors and things like that. But so when people are talking about 5, 7, 10 times multiple, just go back to that sense check of, is that actually realistic? You might get a 5 times, 7 times multiple if in a business that is very rapid growth. So in actual fact, it's not going to take you 5 or 7 years, because the growth of EBITDA is going to make up that. So just again, a bit of sense check around that. Another question that's come in. How important is it that solicitor handling acquisition has experience in the sector of the business? I think it depends on the sector. Is the reality. Certainly on a sector, on a business in a sector that is regulated. For instance, we do a lot of work in healthcare, that's heavily regulated. Transport, again, that is important. But there's a lot of businesses, I don't know, let's take a marketing agency or something like that. As long as your solicitor understands about mergers and acquisitions and risk factors, then you're fine. But I think it's where you're talking about regulation, you ideally need to have someone who understands that particular sector. Nathan, how have you found the transition of businesses after a takeover? So it's all well and good we're talking about how to acquire a business, how to grow. How have you found integration in practice post acquisition?
Mixed bag, I would say. No, it's down to the management team. It's down to your deal team. It's down to how flexible lenders are when there's issues. I think it's you learn a lot, particularly if you're going into an industry that you don't understand. It's a massive learning curve. We understand the business of business, but that doesn't necessarily mean that we understand what that business does. But more often than not, it's fairly comfortable. So obviously, what we do is to look to consolidate. So like Andy pointed out, when we buy another transport business, there's going to be a consolidation exercise. There's going to be integration. You're going to lose some costs because you don't need to duplicate across the costs. But then it's implementing that and make sure that's smooth and works well. And can our managing director run two businesses? Again, going back to what Andy says, and is the lender going to accept that? So I think there's lots of things to consider. But it's the pre-planning where the most important parts come out of it. You've got to kind of predict as much as possible. Your accounts will do cash flow forecast. I think it's easier if you have experience in the industry, definitely. But then again, you can buy that in as well. It's just getting your plan right. I think is the most important thing.
Andy, obviously, there's been a lot going on generally over the last couple of years, which have impacted on the funding market. Obviously, we've had various government-backed schemes. We've had COVID. We've now got Ukraine issues. Overall, how's the funding market? How are these factors impacting on the appetite of funders, shall we say, to lend?
It's a big question.
It is a big question.
I'm not seeing any sort of reduction in appetite. The only thing that I've got first-hand experience of seeing is that when there's a specific asset, so property, and I've seen this in the buy-to-let market, where if somebody's doing a property development, what lenders are tending to look at is what is that exit for that particular development? Is it a sale? Is it a buy-to-let? Because obviously, because of what's happening in Ukraine, it's pushing oil prices up. We're all seeing that, cost of living is going up, and that obviously increases inflation. So with inflation, we've already seen that Bank of England have started to push up rates. I was listening to an economist last week, and he was saying that it could get up to 1.75% by the end of the year. Whether that happens up, I don't know. I'm not an economist, but that will have an effect on lenders going forward, because they will be sort of interrogating you more in terms of what are you going to do with this asset? How is that asset going to perform? Can the business afford it? I'll come back to Nathan and his haulage business. We were talking today, your first question to Nathan was, is the fuel price impacting? Well, of course it's impacting you, because you are having to pay more. But have you factored that into your overall plan, which I know you have? So, there's probably an enhanced due diligence in terms of, how inflation is going to affect things. Will that affect the ability for lenders to lend? No, it probably won't. I think they'll just do a little bit more due diligence.
So we've had another question in about essentially where can you find more information about mergers and acquisitions, fundraising, what have you. There's an awful lot of resource available. Our website ourselves has a buying and selling business guide, which will give you some reading. There are a lot of sort of business mentor type books that are out there that can give you advice around this, and just look out for more courses. I don't know whether you've got any further thoughts on that.
I think books, yes, and speak to your brokers and speak to your solicitors, and because ultimately, those are the guys that are going to be executing the deal, and those guys are going to know what needs to be done to make the deal work. So I think I'd be weary of anybody, going out and doing courses and things, but certainly books. There's loads of great books on this. And yeah, speak to broker.
I think I appreciate I've got a vested interest in saying this, but I think it's really important that you surround yourself with a team of professional advisors who actually understand this market, being that funders, being that your solicitors, being that your accountants. My team alone last year in Ison Harrison, we probably did something in the order of 200 mergers or acquisitions last year. So chances are we've seen pretty much everything. If we've not, so we're going to be able to give you good guidance on not necessarily how much you want to pay for a business, that's your decision, but actually some of the pitfalls and some of the negotiations that come with that. So surround yourself with a team of advisors, I suppose, would be the advice. Yeah. Okay. I think we've covered off. If anyone's got any sort of last questions that you want us to deal with, that please get them in now. Just going to sort of close and sort of coming to you first, Nathan. We'll do it each of us. 3 top tips in terms of acquisitions. What would be?
Having a good deal team. That includes in-house and out-of-house people. Planning. And knowing the sector, getting cash flow right. I think those are my 3 top tips.
Okay. Andy, same question to you.
I'd always come back to the sense check. Does it make sense? Because if it doesn't make sense, then why are you doing it? I'd agree with Nathan, your deal team, so both internal and external. I think having the right advisors will save you in the long run. Having that extra person who has been there, done it, got the t-shirt really does help. And then I would say this, but having a bank of good lenders out there who you can rely on, because until you open the lid of that business, you don't know what funding you're actually going to need. Because as Nathan said earlier about the balance sheet, it's okay looking at Companies House, but when you actually get to see it live, you might, in your head, you might think actually I need some invoice finance in that business, but actually it might be something completely different. So have those relationships in place already.
Yeah. I think and to a certain extent, it's echoing what's already been said, but I think for me, your deal team, your professional advisors, that's paramount. I think personal relationship between the parties, because what can happen in transactions is the lawyers get involved, and I'll be saying, if I'm acting for Nathan, right, where we need this, that, and the other, you don't necessarily know what messaging is coming from the solicitor to the other side, and things can get lost in translation sometimes. Just the actual parties of transaction being able to speak directly, going, actually, what's this in a common sense way? So for an example, on a deal that I've got at the moment, personally, I think sellers' solicitors being quite unreasonable about the limitation of liabilities clauses. He's putting a very, very high bar. And I just think personally that's completely unreasonable. But my impression is I think that's coming from the solicitor, not the seller personally. And actually speaking to my client as a buyer, going, actually, do you just want to have a sensible conversation with the seller, because I don't know who's pushing this, can actually cut out some of that issue. And I suppose lastly, in a general round, detail is important in a deal, but I wouldn't necessarily get hung up on it. Overall, does the deal work? I think we can't lose sight of that, and sometimes people is they get hung up on a particular issue with a particular employee or a particular debt or whatever. And sometimes it's a case of actually taking an overall picture. Is it genuinely a deal breaker? I think that's quite important. So I think that's that's kind of it for us. From us, I haven't seen any more questions come through. So I think for myself and on behalf of Nathan and Andy, thank you very much for coming along today. I hope you find it useful. If you want to find out more about mergers and acquisitions, or you want to have a chat with me about these, then go to isonharrison.co.uk, or my email address is richard.coulthard, that's COULTHARD @isonharrison.co.uk. Thank you, everyone, and hopefully you've been found it informative. I think there will be some feedback questionnaires that come out to you, so it'd be great to get some feedback on what you've seen here today, and if there's potentially any future topics that you'd like us to cover. But otherwise, thank you very much.
Thank you.
Thanks.
Thank you.